Mavericks. This is Darren. I'm joined with Corey Halliday here, and this is the trading room for June 27th to July 1st, 2022. Let's get going. As always, trading contains risks. Make sure you're checking your position sizes and watching your portfolio. So let's talk last week's events. And Corey, what a week it was. I mean, that rally on Friday was one of the most amazing things that I've seen. I mean, that ended a 3-week losing streak with a big bounce. And that carried us back into that 3,900 zone in the spiders. But the funny thing was, energy and commodities had a terrible week in the rotation. We've been talking about energy as being the last bastion if you wanted to be long for a good 6 months. So that's no longer the case, as we're going to see in the sectors. So Chairman Powell testified before Congress on Wednesday and Thursday, and he just reiterated that the Fed is strongly committed to fight against inflation. Interesting, though, is he discussed that possible balance sheet reduction of up to $2 billion. That's not a lot of money. I mean, that's barely a rounding error with the size of the Fed's balance sheet right now. But at least the Fed is coming to the conclusion that I think everyone here has, that a recession is a very real possibility. And it's good that they're finally trying to get their head out of the sand and recognize this. As far as economic reports go, new home sales came in way above expectations, 696,000 new home sales versus 590,000 expected. Manufacturing, the PMI, that came in at 52.4 versus 56 estimate. And the services PMI came in at 51.6 versus 53.9 expectations. So I think this is where we're seeing when the PMI numbers come in below what the expectations were. I think a lot more businesses on the ground are seeing the threat of recession already before the economists can get there. Of minor note, the Michigan consumer sentiment is down to 50.0 versus 50.2. And I think that's the lowest that reading's been since University of Michigan started tracking that over 50 years ago.
Yeah, it's really interesting, Darren, how pessimistic the consumer is. The consumer is probably hit most by food and energy, and that seems to be where the biggest factors of inflation have been. I mean, you're seeing lumber prices are down like 50%, and I'm surprised that these home sales and some of the data comes in because housing affordability has just, gotten out of hand. It's basically double, like from about a year or two ago. If you would have had a $2,000 mortgage, now it's closer to 4,000, and the home sales numbers are still coming in okay. I think that might be a little bit of a lagging factor, that maybe some of these people already had their mortgage rates locked in and so forth. I wouldn't necessarily expect that to be as strong, but it's really a weird market because you have certain things booming and certain things busting. And so it's just little pockets of, strength and weakness out there. But the consumer, definitely, all the consumer data numbers have come in really, really poor lately.
Oh yeah, I mean, we're at the point right now. I've got a V8 in my truck that it's over $100 for me to fill that up, and my wife drives that most of the time. So she's out there every day. I mean, I drive my little Toyota around every now and then, but it was still $80 to fill that up.
Yeah.
Just going to the grocery store. If I can get out of the grocery store for just essentials for under $100, I'm happy. I mean, prices have gone way up, and I lay a lot of the blame at the feet of the Fed. Anybody could have seen with government stimulus and with low interest rates, they should have seen this coming 2 years ago.
For sure.
But I don't want to break my arm patting ourselves on the back here. So why don't you take us through your market analysis there, Corey?
Yeah, let's take a look at a few things here. So we'll pull up the charts. It's kind of an interesting, rebound in the markets. I mean, this week was robust, but really it's almost like these last 2 weeks didn't happen, right? Because as good as this week was, the prior week was just as bad. So it's just kind of, hey, we're back to where we were. And so now this is where the rubber meets the road. This is kind of where, okay, do we have a real reversal that's going to take place? Is it going to be a little choppy? Oil and gold were basically flat. It was all just kind of a rotation back into risk taking and stocks. I'd even put crypto a little bit. Crypto's not a huge market, $1 trillion total value of all crypto or something in that neighborhood. But I think it kind of speaks to a little bit of like the the emotions of risk taking. And last weekend, if anyone watched the crypto markets, well, we know how bad stocks had it last week. Well, crypto had it worse. And then over the weekend, because it always trades, it was just down in the dumps. I think Bitcoin was trading at $18,000, $17,000 a coin. Now, I'm not a big crypto trader, but I kind of looked at this as like, man, the sentiment is just so bad. It's just been collapsing. It went in a straight line from 30,000 to 17,000. And I was kind of using that as, boy, if it gets worse, like if we break to 12, the market's going to get clobbered. But if it could stage a rebound, and before Monday even came around, crypto had bounced back to 21,000, 20-ish thousand in Bitcoin, and I thought, okay, this is kind of we had such a sentiment extreme, so much pessimism, so much negativity, and now we're seeing kind of that exhaustion bounce. It set up for a nice rally this week. I touched on it a little bit in the market roundup. On Tuesday, we jumped up, and I said, well, it'll be a little choppy. Watch, we'll probably pull back a little bit, but we should have room to go higher. And the next day, we kind of dipped down and broke a little bit, and then they gobbled it up, and we finished a little higher. So as we look at the price action, again, I kind of think, for what we lost the week before, we gained back this week. We come up into this area of the gap fill. What happens from here? Well, this is probably an area of frustration. I could see a little bit of a tug of war. Obviously, we're not just going to stick to this number, but if we pull back, they'll try to ram it back up through. And if we ram up through, they'll try to kind of fade it off and pull it back. And I think with us going into the 4th of July weekend, markets are closed, not this coming Monday, but the following. It's just going to be a little bit lighter volumes, and it'll be volatile, but I suspect it won't be as big as the past couple of weeks. It'll be more like, some of the moves will get faded off. The rally will get faded a little bit. The sell-offs will get gobbled up, and a little bit of maybe, point of frustration, kind of frustrate as many people as it can coming and going. The NASDAQ, a little bit of strength in that we've kind of filled through the gap a little bit and closed above the 20 MA. A little bit of extra strength, but you can see, I mean, we could push up towards 300, but there should probably be a little bit of resistance and some pressure against that. As we look at the volatility index, it come off of the highs. We're really just in a high volatility environment that's range bound since, this is kind of where Russia, Ukraine, all of the chaos started. That was the peak in volatility to this point. And now we've just had this big, huge trading range. Are we going to fall to the low end of the range? Are we going to go break through the top end of the range? I suspect, again, my thought is it just it's just going to frustrate and kind of be choppy in here a little bit for the foreseeable future. So I'm not prepared to do anything too aggressive this coming week. I'm not pounding the table to rush out there and buy. I'm not pounding the table to rush out there and short either. My instincts would kind of be to maybe as you spike to the upside, take a little profit off on the bull, and as we spike to the downside, take a little bit of profits off on the bears, or look to adjust a little bit. Just kind of fade a little bit of the reactions would be my general instinct. So this week's events, we kind of think, we're into this resistance, but I wouldn't play it like it's a big breakout zone. I don't think it sets up real favorably to try to, we push through resistance, hurry and try to buy it for a big breakout that's going to run for a few weeks. I'm not so sure that's the setup. If you were playing it for a day or two of, a little bit of burst or something, fine. But expect some choppiness. Expect there to be, some pessimism, some nervousness. This is a little bit of a short squeeze. It can go further. expect the unexpected right now in the markets to a certain extent. Generally speaking, we want to ride trends and ride momentum and so forth. Right now, I think you've got to play it a little bit safer and just wait for better opportunities. The Fed is now in this kind of fight inflation mode. They've talked about it. He testified, like you talked about, before Congress, suggesting that they're going to raise rates and they've got to get inflation under control, and it's a problem that they're well aware of. But it is kind of interesting if you look out on the curve. So there's Fed funds pricing, which basically tries to predict and price out future rate hikes and cuts and so forth. And what they're pricing in is for the Fed to continue to hike rates through the rest of this year, but they're actually expecting the Fed to cut rates later in 2023. Now, isn't that strange that they're already pricing in future Fed rate cuts by the end of next year, about a year and a little bit away? I mean, that kind of tells you the path that the market right now thinks we're on. It thinks we're on a path of hiking rates, fueling an economic recession, maybe a short-lived recession, and then the Fed to go all the way back, flip a full 180, and by the latter part of next year begin cutting rates again. That's how quickly these cycles can go and things can change and so forth. So part of me thinks, it is strange, but the Fed is somewhat hiking rates so that they'll be able to cut them in the future. It's a weird market environment. And realistically, I mean, the Fed unfortunately has a history of creating bigger problems than perhaps they solve. If it were up to me, the Fed would kind of be the last resort. They'd step in only when things are completely out of control. Otherwise, they'd let markets operate and not be constantly in there with bond buying programs and all these sorts of things. But obviously, it's not up to me. Consumer confidence on Tuesday, those numbers, any consumer confidence data has been bad. So I'm not super optimistic about that one. Fed Chair Powell seemingly speaks every week. He'll be speaking on Wednesday this coming week. We get some PCE price index. That's kind of an inflation gauge. And then ISM manufacturing on Friday. Nothing too impactful there, but certainly some things to be aware of as the week shapes up ahead. So, Darren, you want to take us through the weekly outlook?
Yeah, I mean, I'm in the position right now where what's going to hurt the most people. So you take a look at that chart of the S&P right there. You can see we did fill one gap, but we've got another gap just the day before it to fill again. I think that's where we end up. And the moving averages then, I mean, we get right between those two moving averages, and then I think that's where we turn over. So I'm looking at this whole set. This is a setup for me to get short, not necessarily next week, but I think we get up there. I'm going to want two confirmation candles to the downside before I get short again. But then I think this is setting up for a really nice short entry, but I don't want to be too early. I definitely do not want to be too early doing this. So our weekly outlook right here, I'm in a +1. I think we float up. We had a really good day on good long day on Friday. Started at the lows and closed at the highs with on decent volume right there. So I think that carries over into next week. But then I think we kind of flatten out and maybe drift a little bit higher. We're still at a -3 for the monthly outlook just because we're below both the 20 and the 50, and the slope are both negative. So this could change to a -1, -2 next week, and you've got to trade the market in front of you definitely. But I think it is setting everybody up for a really good place to get short again. At least that's what I see. All right, so taking a look at the sectors here. And you can see, the consumer had a nice bounce back. Healthcare had a nice bounce back. The lowest one, energy, -2.5 right there. Materials, that didn't have it as much of a bounce as well. You can see very strong performance across all sectors, and this is a very broad-based rally that we had. Looking at utilities individually here, So I'm at a +1 on utilities. You see, I mean, it had a very, very sharp correction the past 2 weeks, but then it bounced back pretty good. So I think utilities is going to be one of those ones where we're going to see some strength. It does have a lot of damage to get back there, but you can see utilities was fairly strong through a lot of the market volatility that we had. It's just been in the last couple of weeks that it's dropped like that. So I'm going to +1 on utilities. Communication services, I'm at a -2. This one is we had a nice rally on Friday. It still didn't retake its 20-period moving average right there. The volume was decent, but again, I think we're setting up. We can drift up in between the 20 and the 50, and then I think this rolls back over. So I've been -2, -3 on communication services for a long time here. I think we have the short-term bounce, and then it goes back to that as well. Now, moving on to real estate. This is one that looked a little bit better to me. It nearly reclaimed its 20-period moving average right there. It expended a lot of energy to do it. So I'm at a 0 on real estate. I think we get a little bit more. Then I think we start to go sideways, and maybe we roll over. This is one of the stronger looking sectors that we've seen out there. Moving on to industrials. -1 on industrials here. Like I said, you can take a look at most of these charts are in lockstep here. I mean, we get another, 2-3% to the upside possibly, but then I think we go back down. Industrials have not filled that gap that we had a couple of weeks ago. So if we get up there, I think they roll over quicker. 90 is looking to be where I think the resistance is gonna happen. So that's what we're looking at on industrials. -1 for me. Healthcare is in about the same situation as real estate. Healthcare even regained a little bit more. I think we stall out here, though. There was a lot of damage done. A lot of it was recouped, definitely right there. So this is one of the stronger ones, but I'm still at a 0 on healthcare right now. And sometimes in a market like this, 0 is the best that you can. 0 is the strongest that you can have. So I think we hang out here for a little while in healthcare, maybe a little bit more to the upside. If it gets above its 50-period moving average and holds it for a couple of days, then I have to definitely be positive on healthcare again. Financials, I'm at a -1 on financials. You can see we barely filled that previous gap that we had right there. Had good volume right there, but the rest of the week, even though things were choppy, you could see healthcare was, not healthcare, you could see financials was even choppier and a little weaker than a lot of stuff. So I think this is one of the things where financials just got drug along for the ride as everybody was buying everything. They just got bought with everyone else. I don't think there's a lot of strong hands in the financial sector right now, and I think again people are just looking for a place for a good short entry point. I mean, that 33 area right there looks pretty good. That's not too far away for the financials. Consumer had a pretty good bounce. It didn't have as much damage as a lot of the other sectors did in the past 3-4 weeks, and it regained quite a bit right there. So I'm actually at a 0 on consumer, one of the better looking sectors right there. Technology, though, I'm at a -1. We're up there. We're still haven't taken the 20-period moving average right there. We're have a whole nother gap to fill if we can do it. I see us maybe getting to 135 and then rolling over from there. But I think in the midterm, I'm at a -1 on technology here. Base materials, I was really disappointed. Disappointed is probably not the right word because we trade the markets in front of us. But materials had held in there for a while. And that was like one of the strong sectors that we could count on. And it really looked good. It was holding up when a lot of things didn't. And in the past 3 weeks, it's just cratered. Absolutely cratered right there. So you can see Friday was a good day for everything, but basic materials had a especially good day on Friday. But you can see we're so far away. We haven't filled any of the gaps that we've had yet. This is looking pretty weak. I'm at a -1 on materials, but you could make me the case of the -2, and this could be the beginning, as I think we mentioned a couple of weeks ago. We are probably seeing demand destruction at this point because the way things are going in the economy. There's recession on the horizon. Inflation's up there right now. I think if you're involved in materials, I mean, we're talking inputs to a lot of these industrial companies, and they're not seeing the materials companies are not seeing the orders from the industrials, I think this is leaking out into it, and I think this is going to be a leading indicator of when people think the market's going to bounce, when materials finally puts in a good bottom and starts going higher. Finally, energy. Energy had been the golden boy for nearly a year, and it was really the place to do. But you can see the past 3 weeks have not been kind to it. I mean, it's not as bad looking a chart as materials is, but I think it's indicative. I think it's reflective of that demand destruction that we're beginning to see. So even on Friday, with everything else being bought, energy was just an inside candle. Possibly you call it doji, that'd be fine right there. Just not a lot of interest in it. Thursday was a completely ugly day for energy as well. So we're back to March levels. So we've gotten rid of 4 months of gains in 2 weeks. So things not looking good for the energy sector. This is not a place that I want to be long, not necessarily a place I want to short heavily, but definitely a place I don't want to be long. All right, so let's see how the sectors stack up right there. On the low end, we've got communication services at -2, and we've got materials, industrials, financials, and tech all at -1s. Things that are looking okay. Wouldn't want to necessarily be too long or too short any of these. Healthcare, consumer, energy, and real estate. And I think utilities has the best case for being the strongest sector right now. So that's where we are as far as how the sectors stack up. So let's take a look at some possible trades here. Okay, so last week we were short WELL. I think that's WellPoint. That is real estate. This is one of those weeks where things just didn't look too good. So while we were short WELL, it was up 7.35%. So not something that we're just going to write that one off. This one is in utilities. This is Constellation Energy, symbol CEG. And there's a couple of different things you can do right now. If you want to play a little more conservatively, you can go out to this next week's 55, 60, 65 butterfly, or you could go, if you want to play it a little more aggressively and think that this has some legs, go long the monthly July 50s and short this Friday's 60 and make it turn it into a diagonal call spread right there. So communication services. Got the New York Times. Okay, this isn't one that I think we've traded for a while. And that's the great thing about using the screener. You don't have to work. You don't have to know the stock. You're just looking for performance right there. This is called a bear, small bear rally, low base. I would wait for confirmation on this. I would go out to the monthly Julys and go long the 30 puts and short this Friday's 28s against it. And that way you can decide if you want to hold on to it. If you don't want to do that, then I would just do a 28-30 bear call spread right there. Either one looks pretty good. And healthcare, we've got Day One Biopharma, symbols DAWN. Okay, this one had been in a long downtrend for a tremendous amount of time. Getting down to the below $10. I think bombed out at $6 right there. Then whatever happened, news, it's probably what it was. Something went well for the company. It took off and it's kept going for right there. So I'm just calling this a breakout, and everybody wants to buy it, it looks like. So I'm going to go long the July 15s, and this next Friday I'm going to short the 20s, and probably if it goes, I'm going to hold on to those 15 calls until they expire.
All right, let's take a look at industrials. So in the industrial space, we've got Zim. This was one that we highlighted, I think, last week that's already starting to work, already down some, and I think it's just the right place to be in terms of ideas. You can see, I mean, from a charting perspective, we actually broke to new lows in what was a very strong market environment, kind of an inverse cup and handle type of pattern, but ultimately breaking to new lows. We could see playing this as a diagonal put spread. I could see just buying a put spread, something like that, where you're just targeting some downside. Obviously, we're a little bit, I mean, we came in last week expecting the markets to bounce. We expect a little bit more follow through this week, more so than the downside. So, my best guess is the market's up 1%, 2%, whatever by the end of the week. So you don't want to be too aggressive maybe with some of these bearish picks, but ultimately that one kind of looks interesting as a downside trade. Now, let's take a look at financials. So in the financial space, we had highlighted FUTU, I believe, last week on the financial side, and it was up 18% or something. Big, robust rally. Here you've got more of a bearish candidate. And I mean, it's not, these are similar price patterns to kind of what we look for in terms of bearishness or bullishness. If you're just trading from a charting perspective, we're in a downtrend. We really can't elevate even in a good market. Perhaps there's more follow through. So I'd probably play it with some sort of spread again because I don't want to just be too aggressive on my bearish bets in an upward moving market. But ultimately, that one can be on the watch list for possible entries or triggers. On the consumer side, so GameStop, now here's a stock that has held up relatively well, but you could play this one more sideways. I mean, I don't know that GameStop has necessarily. It's a tricky one because you have what is it, Reddit? You've got the Reddit crowd behind GameStop, so at any point in time it could spike. But the natural draw, if you go back to when it very first had its spike, it's consistently made lower highs, lower highs, lower highs. And as we look at it, we're just kind of in this big trading range. You can see spikes, but we would like it as more of a neutral trade. Now, what's interesting is because everyone's so nervous about GameStop, its butterflies price out to better risk to reward, and that's the nature of these. If you have a more volatile stock, you get better risk and reward because the market's saying, hey, this won't stay sideways. It's less likely, it has a lower probability, so you get a better risk to reward. Well, we just have to be aware that these don't have to be held to expiration. You might kind of move away from here and then come back to the butterfly zone, and that's probably a profit taking opportunity. Or if we kind of pull back and then we come back up, that's your profit taking opportunity. I don't always hold these to expiration because if you get to the body of the butterfly, you have to ask yourself, if you're a week early, well, I know GameStop's not going to perfectly flatline all week. So I literally know it's not going to stay at 140. Best case, it moves and then it comes back. Do I want to keep betting on it coming back for 5 more days? Perhaps not. I might take my profits early, but you'll need to waste some time playing these as neutral trades, meaning it will need to kind of go away and come back once. I'm not sure it'll keep doing it over and over again. So if you get that kind of move away and come back, you'll have a nice profit in your butterfly. Look to take profits on that type of position. In the tech space, so technology, GFS, global foundries, here you can see again underperformance in a bullish market down at the lows. I could see a little handle or some sort of pattern here where it bounces a little to initiate, but we're looking at diagonal put spreads. Again, usually spreads on anything bearish because I just don't want to be super, super aggressive just yet. I think by the time next week comes around, get past this week, have a little bit more of a market rally, then I think the aggressiveness towards the bear side makes more sense. But I don't know that we're there quite yet. Darren talked about the disappointment in materials, and it kind of makes sense fundamentally. I mean, you think about iron ore and copper and steel, and I mean, if you're a company, how aggressively do you want to be buying steel and starting to plan out big projects and bet on consumer demand and so on? You kind of have to look at this as, man, rates are spiking, building and growth and all of that. We might be headed towards an economic recession. These companies are probably going to be a little bit nervous about the visibility out the next 6 months, the next 12 months. So I don't know that they're going to be super aggressive when we're starting to see that priced into some of these commodity areas like materials and even energy for the first time in a while. So OLN, low base pattern, you can kind of see this has traded down again towards those lows. You could get a little bounce, but on these bounces and things, look to initiate your bear spreads. We were looking at July monthly 48s and selling the July weeklies against it or things like that. And like Rob does, you can kind of test the trade a little bit, test it out, see if it's working. If it is, stick with the long. If it's not, you can bail out for a small loss. So those types of ideas could be interesting. Last but not least, energy. So EQT, maybe a little bit more of a, hey, we just won't go up or down a lot, but play it as a little bit of a spread for a little bit more downside. So you can see it went from 50 down here to 33. Do we expect it to now go to 17? No, I wouldn't be too aggressive, but trading it to kind of play down here towards 30, towards this prior breakdown zone, a bear call or a bear put spread or something like that, down around that zone could perfectly make sense. I might even like to initiate the trade on a minor bounce, but either way, some of these look like opportunities to continue to play fade the rally, and this is where rotations have happened pretty aggressively. So this has turned from buy the dip into a lot of people probably in pain on this sell-off. They may be inclined to sell the rallies here a little bit in the short term.
Yeah, thanks, Corey. It was interesting, especially in the materials sector. So in case you haven't seen our class on how to use the screener in FinViz, you choose the sector, the criteria I use, make sure it's optionable and shortable. I want the average volume over 2 million shares, and then I sort performance by month. And that's how I get a lot of these things. I think in the materials sector, there were only 3 stocks that fit that criteria that were up for the month. And so there is nothing that looks good over the past month in that materials sector. And you mentioned, well, do we expect EQT to go down to 17? No, probably not. But I was looking at some others that had fallen even farther, like Petrobras. That one has wiped out 6 months of gains, I think. So when a bear market gets its legs and starts going down, things trade down below any reasonable valuation. That's just the nature of it. That's the nature of these bear markets. But talking about the market at hand, is this a bounce or a bottom? I personally think it's a bounce. I think we do roll over. I think that we need to have more clarity on where the economy is going before we can call it a bottom. And I think the bellwether is going to be that material sector. Once we can get a bottom in the material sector and we can start making headway, I think then we can say, okay, the inputs are looking like they're getting their orders. That's when we can start to say we can see an end to what the recession is. But until we get that, I think we go into full-blown recession. And I think we have a lot more pain on the downside right now. One thing, watch your portfolio mix. In a market like this, don't get too bullish on the bounce. Don't get too bearish waiting for the rally to end. Make sure you've got a good mix in there. If you do think it's going to go back to the bearish side, we have to wait for that confirmation. The trader in me 20 years ago probably would have shorted at the close today, and I would have been wrong. Now, I would have been wrong because I don't have that confirmation. Wait for the confirmation before you get back net short. And as always, watch your position size. You don't want to have too much concentration in any one single position. So next week, we've got on Monday, we've got trading ERX, and that's going to be recording. We found that we can produce a much better product doing the recording during the day, editing it, and then getting it out to our traders than we can try to do it live. Now, the exception to that is going to be the midweek updates. That's still going to be live on Wednesday, the 29th at 10 Mountain Time, noon Eastern. A lot of good feedback we get from those. We definitely want to keep the midweek updates live. And then on Thursday, we're going to have targeted butterfly spreads. Teach you how to find those, teach you how to trade those, and that's what we're going to be looking at for this next week. So as always, thank you everybody for attending. Have a good trade.